We go across to Vinay, Jaising, CIO and Head Equity Advisory, Ask Private Wealth. Vinay, you're joining at an interesting time in this morning's coverage when suddenly markets are perking up and finding something to be excited about. But are you feeling largely optimistic and looking at value right now when you see the screen, or are you thinking that there is some issues which need to settle down first? What is the mood right now?
So very clearly, the mood is macro vulnerability is, I think, the two words which come in every investor's mind, be it FII outflows or be it crude oil prices. These two is leading to a dual issue as far as the country is concerned, be it the fiscal, be it the current account deficit. Both are being questioned. I don't think India has been questioned on the economy front, I think in the last 4 to 5 years, as much as it's being questioned today. Because of this reason, the mood is clearly somber as compared to being a lot more optimistic for India as a country. Having said that, a very big silver lining which has come into the picture has been the quarterly results. Remember, the results of the quarter, Jan, Feb, March, which have come out have been virtually pre-war. There were 2 months of no war, and the month of March was when the war started. So it's had 2 months of pre-war and inventory which helped them. And out here, the earnings surprised a lot more for the mid-cap space and the small-cap space. And as we are aware, when earnings come, that space of the market has done a lot more better than the large-cap space, which is, I won't say disappointed in earnings, but, it's been not too good as far as earnings are concerned. So to summarize, two key variables where the market is looking out for: energy, FI outflows, leading to a lot of pain as far as Forex is concerned. At 95.6, India is the worst performing currency in the last year, down as much as 13 to 14%.
Okay. Vinay, we are at the cusp of the monetary policy decision, and the decision may well be standing pat and not doing anything. There is talk, and our colleague Shrimi is just at about 9:15 odd broken the story about the possibility, right, of some changes to taxation on the debt side for FPIs as well. It may be yet another attempt to give some breathing space to the Reserve Bank of India as well for standing pat. What do you think the RBI does and says, and what could the impact of that be on equity markets?
Thank you. Wonderful question. If you look at what's happened in the last 3 months, we've had $50 billion of outflow, right? So the overall Forex reserve is down from almost 730 to about 680. I'm not counting about the net shorts because then the numbers are much lower at about, somewhere close to 580 billion. So that pain point coming in, be it either because of oil prices or FI, is a pending issue. The REER has gone to 91 levels, which means that, the rupee is oversold, but there is a lot more pressure. Can the rupee go to 100 is the question people are asking. So what can RBI do? If I look simply at a 5-year stretch and look at the interest rates 5 years earlier to 5 years today between US and India, and look at the 10-year rate. 5 years ago, the differential between the two was 4.5%. It was not that the Indian interest rate was much higher. The US interest rates were much lower. Today, the interest rate differential is 7 minus 4.5, about 2.5%. So that differential gap, if earlier we could get FIIs coming into the country thinking, that we'll come up with a debt instrument, or if we were to raise interest rates, we were already at a 4.5% gap. Now, to bridge that gap, you have 150 to 200 basis point interest rate required for FIIs to look at India a lot more interestingly, or for us to put up a debt paper. So if RBI were to raise interest, I'm just saying hypothetically, by about 25 basis points, as US is also expected to raise interest between December and January by about 25 basis points, that is not going to change the needle. I repeat, that is not going to change the needle. So it is not what RBI does on Friday, which is as important as other levers which RBI or the Indian government uses to stabilize the rupee. What can they do? The biggest thing, and they did that in taper tantrum times. Remember, in taper tantrum times, the interest rate was increased by 300 basis points, not 25 basis points, right? So if you want to get some NRI deposits coming into the country, you need to have some losses made by the banks and a much higher, much more lucrative rate given to the foreigners to get money into the country. The other choice is obviously reducing the withholding tax as far as debt is concerned first, and obviously looking at what's happening to the equity market as well, reducing the long-term and the short-term capital gain tax for the global investors. So these are thoughts which the government has to very seriously look at today, a lot more than ever before.
Vinay, we're reporting that the government is planning an ordinance. We could get the details anytime, really, to ease off some kind of taxation and attract FPIs. What we are hearing, and I'm not asking you to comment on what we're hearing, there is a broader question, don't worry about it. What we're hearing is that the 12.5% long-term capital gains tax on G-Secs for FPIs may be waived off. Is that going to be enough? Is there anything really that can be done in the form of these tax eases which could come in that will actually attract FPIs back, or is there a bigger issue here at play?
This isn't, if the government were to reduce the withholding tax of 12.5% or higher number for the debt instruments, you will probably see India getting into the Bloomberg index for the world, and you'll start seeing $24 to $25 billion of debt inflows coming into the country, which could clearly in the medium term reduce anything as far as forex reserves are concerned, which is increase the forex reserve, reduce the problem as far as the rupee depreciation is concerned. So that would be an amazing move. That would get Indian debt into the limelight as well. The markets would cheer for it, absolutely. And that's one of the things which the government may be forced to do.
Yeah, so Vinay, in some sense, is this, if this were to happen, right, is it more an attempt to give breathing room to the Reserve Bank of India under the current stage and not as much a move to get FIs lock, stock, barrel into the country? This is one of the many attempts that you reckon the Reserve Bank of India could do or the government could do.
I think this is one of the best attempts. I'm just changing your words a little bit.
No, of course.
It's one of the best attempts for the government to do, which is not touch, the interest rates, because as I said, 25 basis points is not going to change the needle. You need to raise it a lot more. So if you don't want to do that, you're pretty comfortable with the inflation levels as far as India is concerned. Remember one point on inflation, because it's important out here. Our oil analyst tells us the oil price, petrol or diesel price hike in India at about 7 to 8% is way lower than the rest of the world, where it's been about between 20% to 50%. So inflation is not going to hit India as much. So you would normally not raise interest rates. Now, if you normally would not raise interest rates and the country is getting into a capex cycle, the issue is more the current account and the fiscal deficit. To solve that, why not first cut the withholding tax on the debt front to attract foreign debt coming into the country? Once the foreign debt issue gets partly solved, the forex reserve issue gets solved and the rupee stabilizes. I think that's one of the best actions the government could take today.
Okay, let's talk about what looks attractive right now, Vinay. And we had a rousing debate earlier in the show where we had a bull case and a bear case for the IT sector, considering the kind of volatility we have and how fickle-minded investors seem to be, whether it's one statement from Jaising or one brokerage on Accenture, and then the entire mood changes. Are you seeing any value in Indian IT software companies as they stand? And are you finding the valuations currently attractive, or do you think there's more pain to come?
I think the valuations are attractive, but for the stocks to move up substantially, a lot more needs to be done. So think of it this way, right? Where is the earnings trajectory increasing? In those small and mid-cap stocks where CapEx is going their way, where they're getting the gain of the dollar because of what they're exporting, where they're getting a lot of, CapEx coming in from the power industry, which is of US giving orders into India, again, linked to the AI chain. That's the space where you're seeing the earnings momentum growth being, 25, 30% or even higher. In the case of IT companies, what we're saying is the dollar will, they would gain on the dollar. There's always been an issue on H-1B visas, and, that will be something which will exist for a long period of time. You're getting, I think you're getting into a boxing match, you're getting into a battle. One after the other. In such an environment, why should an investor look to be equal weight or overweight the IT sector for the short or medium term when you know AI as a basket, as digital did to them, is going to question their revenue growth? If earlier the revenue growth was 10 to 12%, whether to 6 to 8%, it may not go down to zero. So obviously there will be a valuation which you want to look at because these are very high return on capital employed companies, high dividend yield stories, very robust companies. But as far as stock market is concerned, I think the IT sector, for us would be an underweight call. How much underweight is the question? But yes, there is valuation, but no triggers which we can see in the foreseeable future.
Okay. Well, so avoid that bucket. But the other one is the interesting one. And Vinay, I want your view here. But I just want to get in my colleague Varsha to give us what one of the brokers, which is Citi, is speaking about speaking about the electrical equipment space. And I believe they've initiated some coverage on 3 or 4 names out there, Varsha.
Yes, absolutely. So Citi has initiated coverage on Hitachi Energy with target price of 46,700, then GVTND and also CG Power, and they've maintained their neutral on Siemens Energy. Now let's see what are the key reasons. For Hitachi Energy, this is seen as a leader when it comes to HV and HVDC. For GE Vernova TND is expected to benefit from strong HVDC opportunity and export exposure. And for CG Power, considering it has diversified exposure across transmission semiconductors. Siemens Energy, if you see, they've maintained their stance neutral as limited near-term HVDC plays expected. Now onto the renewable penetration, the data centers is expected to drive $15 trillion global T&D capex from FY25 to 50. Renewable is expected to account for 80% of future capacity additions, and a strong export opportunity is emerging for Indian manufacturers according to Citi. And HVDC, this is the current key topic when it comes to the India electricals. HVDC is alone seen as 1.6 lakh crore OEM opportunity, and hence T&D stocks have already re-rated, but further upside is possible according to Citi. So Citi is bullish when it comes to India electrical, considering the HVDC opportunity.
Okay, thanks for that, and thanks for bringing that, Varsha. Vinay, it seems to be a clear and present opportunity. Valuations may be a pickle with a few. How do you think about this space?
So, let me slow down and go back to what's working in the world, right? If you look at the large cap space globally, driven by AI, if you look at what's happening in Korea, you look at what's happening in Taiwan, clearly the AI hyperscalers, the rate of growth of the earnings which came out for even NVIDIA, they all have been very, very robust. Very, very robust means north of 50 to 60%, much higher in countries like Korea and Taiwan. So the earnings are growing there. The capex is increasing there. At one time, the Magnificent Seven spent a capex of about $600 or $650 billion last year. Now we're talking about the capex spend on AI being close to $950 to $1 trillion. That capex is going to come. Once it comes, if you break that capex up based on our analysts, just taking a ratio of 70-30, 70% going to hyperscalers, 30% of that chunk, or about $300 billion, comes all the way, all the way coming into transmission equipment, into power equipment, into data equipment, into infrastructure equipment, into cables. Now, you got to look at the space where India is spending money, increasing the capex in the country and selling it to the rest of the world. And there are many companies, you mentioned one sector, which was industrial transmission. There's another sector in generation. There's another space in pipes. There's another space in hot boxes. There's another space in airplanes. So there is a big precision equipment space which is gaining substantially as far as AI infrastructure is concerned. And that's what I meant. When you were talking to me earlier about IT, where rate of growth of earnings could be 8 to 10%. Here, the rate of growth of earnings, because they've got order books, some of them of 10 to 11 years. Compared to the last year's revenue book, have order books which will lead to profit growth of 40 to 50%. That's really the space to look at as far as we are concerned.
Wow. Okay. Vinay, such a pleasure talking to you. Thanks so much for joining in and the takeaway, the key takeaway, Tamanna, for me from this conversation with Vinay. He's saying this is the best move that can be done in the near term for attracting flows and showing the rupee and more from the government side.
Yes, you're seeing that in the way the markets are